And welcome to everyone here today. I am Stacy Francis, the moderator for our special talk today. We're going to be talking about the election, your portfolio, and we have two phenomenally important guests with us here today, and I have a lot to say about them. But before we get into our session today, I wanted to take you through the ability to make sure that you can answer any questions, have any questions you have. So if you look down to the right, you should see Q&A, and feel free to go ahead and write any questions that you have, and we'll try to make sure that we answer them during our time today. If for some reason we are not able to get to your question, if you could kindly just let us know, we'll be sure to reach out to you in the next day or two with an answer to your question. We even can jump on the phone with you. So today, as I mentioned, we have two very special guests, again, talking about the presidential election as well as your financial future. I know for many people, coming up to the election is a very anxiety-provoking situation. It's a very close race, and Matt actually has some data fresh off the press to talk a little bit more about that. But in addition to the concerns we have about the political climate, also the market. And my hope today is that at the end of our session, you are going to walk away with a lot more knowledge, a lot more empowerment, much more empowerment, and truly understanding about how the market reacts to the election in the past and what we expect for this election going forward. So let me introduce our two VIPs here today. Matt Haertzen is both a CFA Chartered Financial Analyst as well as a CFP Certified Financial Planner. And he has over 25 years of experience working in investment strategy. We love working with Matt. Matt, I'm sure, is familiar to many of you. He is our Chief Investment Officer, CIO, here at Francis Financial, and he keeps himself pretty darn busy. He's also a senior lecturer for the Eller College of Management at the University of Arizona. And come the winter, I'm going to be very jealous of him being in Arizona. But what's so special about Matt is he brings a combination of not only detailed investment expertise, but also an ability to really talk about some of the most complex financial topics in a way that's easy to understand. And he also has a passion for outdoors. And actually, one of our colleagues, my partner, Avni Ramani, just went out to go visit him. Right now, he's actually zooming in from Colorado and lives a wonderful life of outdoors, biking and hiking and kayaking. And it's great to have you here. Thank you, Matt.
Thanks, Stacy. Thanks for the nice introduction.
And Apollo is someone that I've known for years and one of our power partners to help our clients succeed and thrive in the stock market. And he works at Dimensional Fund Advisors as a vice president. He's been started there in, if you can believe that, 2004, after finishing his PhD of economics at the University of California, Santa Barbara. He started the Dimensional Fund Advisors strategy group, and it works directly with advisors like us, particularly in the Northeast, helping us be able to offer great investment options to our clients through their many fund options that they offer. And before starting at Dimensional many years ago, Apollo actually had his own consulting firm providing services to the U.S. Department of State and the White House on various projects. And I've been fortunate enough to know Apollo over the years and actually meet his daughter, who is a superstar and rock star in her own right. Hopefully, I imagine maybe following in her father's footsteps. And it's great to have you here today, Apollo, as well.
Hi, Stacy. Thank you so much for the invitation. And yeah, it's been so fun knowing you over the years. And I also appreciate it because my daughter got so much from being an intern at Savvy Ladies this summer. And she had an amazing experience. And what an organization. I mean, it's top notch. So thank you on multiple levels. And it's great to be here.
Oh, thank you so much. And for those of you who maybe don't know about Savvy Ladies, I started Savvy Ladies. I was a lot younger. I was about 26, and it is the actually largest nonprofit in the United States that helps women in need with financial education. And then the year after started Francis Financial. So Francis Financial has allowed us to be able to donate big to Savvy Ladies and help those in need. And I have to tell you, I could not love my life more of having this beautiful charity and this wonderful work that we do, helping those that most need it, and Francis Financial, helping all of you that are tuning in today. So I want to get started because we have a lot to go through, and I will tell you, all of you listening, we have trimmed this down because we know that we could go for hours and hours and hours because this is such a big topic. But we're going to really try and keep this to 45 minutes and also be able to allow you to ask questions throughout. So we're going to be talking about a lot of different topics. But the first piece is really addressing the concerns that we have heard from some of our clients and others about how the presidential election could impact their portfolio. And we're going to be talking about the election and really talking about the market in the purposes of how the market dislikes uncertainty, how long-term investors have been rewarded by staying in the market, and also ending with some actionable steps for all of us to take to help us sleep safely, sleep with peace of mind, and be able to know what's going on with our portfolio. So I'm going to go ahead and throw this out. We have the first question. Investors, we definitely are seeing as you watch CNBC, you watch CNN, we're seeing an uptick in reporting specifically about the upcoming election and the stock market. And there are many different concerns from taxes to government regulations and others. But a question I have, and either of you can jump on this, how should investors think about these concerns in the context of their investment? So what should we be thinking about with all the noise that's going on in Washington related to our investment portfolio?
Sure, Stacy, let me jump in on that one and just take a little piece at it. You mentioned that I had some facts. I participated in an event with another investment firm here over the last week where they were talking quite a bit about the election and the investments and what was happening there. And they mentioned that this is the closest election we've had in 60 years. So if you go back to 1964, we've had 16 elections. And this is the first time that one candidate hasn't led by more than 5 points in an average of all the polls for at least 3 weeks. And so that's how tight the election is. And it's really ties into what we've seen with sort of a divided country. If you look just here in the 21st century, we've had 6 elections. 5 of those have been won by less than 5%. That's how narrow the gap's been between those. And if you look back to the 20th century, all the elections that we had there, that only happened 5 times over that entire 100-year time period. So I think that's part of what's causing a little bit of the stress is there's more uncertainty here. It's not as clear about who's winning. Obviously very polarized from an overall country perspective as well. But I put 2 charts there that I wanted to just briefly walk through that I think might help with that. And Stacy, okay, you got that pulled up. And this first one is really busy, and I don't expect anybody to be able to see it. But what I wanted to stress here is we're thinking about this not from how we feel about politics, but how do we feel about positioning portfolios, is if you go back here to 1970, obviously a number of elections since that time period, and you just invested and stayed invested for the entire period, your 10,000 grew to just over $2 million over that time period. And what you see, what's busy about this chart is just how many reasons there were to not be invested, how many reasons there were to be concerned. Obviously 2011 that we just had the anniversary of here not that long ago, many events throughout that time period. But if you stayed the course, you stayed invested and you stayed focused, obviously turning 10,000 into 2.3 million is pretty good. If we look more specifically, Stacy, in that next chart, what you'll see there is if we only invested based on who was in office, whether that was a Democrat or Republican there. And you can see, the line that's the higher line, the black line there at the top, is if you just stayed invested for the entire time period. And this goes back to, a number of years at this point, versus if you invested when the Republicans were in office, or if you invested in when the Democrats were in the office. And as you probably expect from the colors, the blue line is I only stayed invested when we had a Democratic president. Red line is only when I had a Republican president. And you can see your portfolio is a lot worse off. So one of the things, I think that we want to stress, key takeaway from today, is we've looked at past results, and we'll get more into this as we go forward. Biggest thing that people can do, and it's one of the hardest things in the world to do, is sometimes to do nothing and step back, remove the emotion. And that's really, one of our charges, one of my most important charges working with our clients, is to say, we don't want to make changes based on emotion. We want to look at the impact from an investment perspective, what the economy is doing, all of those things. And the results have been pretty strong if we stay with that.
And I think that it's interesting because there's a big question. It seems like what's happening in the government can really impact the stock market. And so, talking about historically, is that historically true where, which party is in power impacts the stock market, or is that something that is just a phenomenon we see here and there?
Yeah, and I think to really answer that question, kind of going back to what Matt was saying as a starting point, I think one of the most fundamental things that I've seen this particular election cycle is that it feels different to everybody, that we've never seen something like this, and there's a lot of anxiety. And then Stacy and Matt, I have traveled the country doing these events, and I find that there is anxiety everywhere. In some parts of the country, the anxiety is, what if we have an autocrat that's, democracy is not going to hold up? In other parts of the country you go, and the anxiety is about, what if we have a socialist coming in and all of a sudden the government is going to tell us what to do and we're not going to have as many freedoms. So anxiety is everywhere. And that's what triggers those emotions that Matt was talking about. And I could not agree with him more. I think that successful investors acknowledge these emotions. And I think we have to acknowledge them because they're real, and that's what makes us human. And I think we ought to act on them the right way. We happen to live in a free country where you can go cast your vote. That's probably the best way to do it. Get involved in a campaign if you feel strongly about it. So use those emotions, channel them the right way. But what he was saying is so fundamentally true. Successful investors acknowledge these emotions, and at the same time, they disentangle them, and they make decisions about their money on much more pragmatic reasons, such as data and evidence. Not how we feel, but what do the numbers say? And to answer Stacy's question, I think to understand this, there are two fundamental premises that I'm going to lay out. The first one is the stock market. To begin with, I think those words are not necessarily the best way that I would describe it, because the stock market is an ownership mart. It's a place where you and I can buy ownership in companies that we did not start. And the role of this mart is to establish the value. How much is it worth paying for the ownership in that company? That's what the stock market is. So in the context of the election, what the stock market fundamentally does, it's assessing the impact of any one president on the potential earnings of a company. And we're going to come back to this over and over again. It's a very cold calculation. It doesn't have to do with civil liberties. It doesn't have to do with reproductive rights. It doesn't have to do with any of that. It has to do with that premise. How is the policies that might come into play impacting the earnings and the profits of every single company in the stock market? But the second thing is that all of you, if you're clients of Francis Financial, you have a plan. And that's the most important thing in investing, having a financial plan. And in that financial plan, some of your money might be allocated into the stock market. On the other hand, you could also have some money allocated to bonds. And that's a very different type of investment. You can have money invested in international stocks. So not every penny that you have could necessarily be in the market the way you see it on the news. So you have to realize that a financial plan was built to withstand times like this, and really make sure that it gives you the best chance to accomplish your financial goal, given all the nuttiness that exists right now. But it's all about earnings. It's all about your financial plan. That's what fundamentally should be the starting point, in my opinion.
I love that you bring that up, Apollo, because I think that some people give the market more credit than it deserves. And you just really laser focused on what the market's concerned about. The market's just concerned about, are companies going to do better or do worse from a profit perspective based on who ends up getting elected? And you're right, it's not about reproductive rights. It's not about many of the other issues. It truly is a cold calculation of where which leader is going to result in higher profits for companies that will then yield and equal higher stock prices, right? And it's
Absolutely.
all about that. And I think that we often think that because the market does have so much volatility, that it's about a lot of other issues. And again, if we just really boil it down, it's just where is the market going to do better? Where's the market going to do better? Make more money.
Absolutely. And I think there's a seductive narrative, Stacy, that perhaps looking at policies will guide you into what to do with your money. And assertive policies are going to lead to the markets doing better or worse. And let's take a couple of quick examples specifically to this. Should you guide your investments based on what might happen in terms of government policies? And I'm going to use two quick examples. One is coming from the previous administration. And if you remember back in 2017, as the previous administration took office, they were talking a lot about supporting domestic manufacturing. And one of the industries that they kind of honed in on was steel, the U.S. steel industry. And Stacy, turns out there's a company that carries the name of the industry. It's called United States Steel Corporation. And it's really instructive to go back to what happened those days, because there are two elements that I'm going to come back over and over. The first thing is that markets tend to, and these investors they're talking about, they tend to pay attention to the news. And what they see is an expectation of a benefit to a company or an industry because of policies. It tends to be incorporated into the prices really quickly. So if you expect the benefit from the government policies, then that expectation will be priced in before even that policy gets implemented. And number two, this is not about the industry as a whole, because it is much more about the company itself. And let's give an example. U.S. Steel, just as the president kind of settled in and you had these talks about the manufacturing, the price per share for U.S. Steel at the beginning in January to February or so, the first part of the administration start going down. And then all of a sudden you had this talk of potential tariffs. And nobody knew if the tariffs are going to come in or not. But there was an expectation that the government might do something to help U.S. Steel. And all of a sudden, you see the price going up. And in fact, in March of 2018, steel tariffs were announced, meaning that U.S. Steel became much more competitive because it had the tariffs that other companies from abroad would have to pay. So that actually gave them a huge leg up in the market. So again, the seductive narrative would say, well, then, listen, we got the tariffs. The U.S. government is fully behind U.S. Steel. Well, we ought to put more money in U.S. Steel because that's where the benefit is. Well, it turns out that if you look at the time between the tariffs were imposed and the end of the administration, U.S. Steel lost the majority of its value. The majority of its value, despite the fact that it had the backing of the U.S. government. So that seductive narrative that somehow the government getting behind or not getting behind is helping, that's not necessarily backed up by data. In recent times, I'm going to talk about the current administration because one of the big pushes has been in green energy. And somebody could say, well, that's a good sector to be invested in. Again, investors anticipate that, hey, if we're going to have these policies, these companies will benefit, and they tend to price that in pretty early. And in fact, sometimes it takes a second or two. So it's very, very quick to incorporate those expectations. And in 2021, funny enough, Stacy, I was looking to put solar panels on my roof. And at the time, I got a few quotes. And one of the companies that I got a quote from, solar panels, is still called First Solar. And if you look at First Solar for the past 3.5 years or so through the end of August, it's quite remarkable because First Solar pretty much doubled in price. So you would have doubled your money, twice the money that you started with. So it's a really a good way to look at it is, hey, perhaps having this government backup helped investors because they doubled their money in 3.5 years. That's really good. The other company that I got a quote from was called Sunrun. And when I looked at Sunrun over the exact same time period, Sunrun pretty much lost 75% of its value. It dropped 75% in value, even though it's still a solar panel company that doesn't seem to have benefited it. So it is something that is company by company, and it might have to do with their products, the strategy, execution. But what's also so interesting is that the one company that hasn't been in favor, one industry that hasn't been in favor, fossil fuel, you can take ExxonMobil over the exact same time frame, it tripled in value. It tripled in value, and it didn't have any government backing. So the point being here is that, again, don't get caught up in the seductive narrative that somehow government policies are going to really benefit an industry or a company. It's unclear. There's so many other things that matter. Their strategy, the execution, the products, the services they provide, competitors, so many other things. And because of that, we don't suggest that you ought to pay attention as much because the markets are very quick to price that in. And it's ultimately each individual company that determines its destiny.
Yeah, definitely agree to Paul. I mean, if you even think about the interest rate increases just, very recently, a lot of those were already priced into the market. And I love your message, and it's so spot on of not letting government policy impact the way that you are investing. And I want to kick it over to you, Matt, because conventional wisdom shows us that the market doesn't like uncertainty. I get it, right? No one likes to not know what's around the corner. But can you talk about, in particular, how has the market performed during election years? What does that look like? And I'm happy to share a slide too if you want me to.
Yeah, no, I think you hit it exactly right, Stacy. The market doesn't like uncertainty, and that sort of ties back to where we started in the first discussion, which is this whole idea of this election being as close as it is. The markets don't like that, and we're seeing, we've certainly seen a lot of volatility. If you look at what happened in the market at the start of August, we had a pretty sharp downturn, recovered, had a very nice return in August. September, it's exactly repeating the same cycle here as we're moving through, and so that uncertainty's definitely led to more volatility. And this chart here that you're sharing, I think highlights that well, where when investors get nervous about that uncertainty and that volatility and step out of the market, they say we're going to step away, that ends up lowering their returns over time. And you can see the purple line on this particular chart there, that buy and hold investor, again, substantial outperformance relative to the person who tries to adjust and reduce that volatility in their portfolio. Remember, the reason we invest, we have to take risk. If we don't want to take risk, the only thing we can buy today is a 10-year treasury that's now paying about 3.7%. You do a great job with the financial planning, and we do as a team here putting that together, but we generally need returns higher than 3.7 over time. So we're going to have to take that risk. But if we stay invested, you see here that the returns actually turn out pretty good. And if you go to the next chart, specifically in presidential election years, and I know it's a little bit small and hard to see, but you can see, generally speaking, the presidential election years have been really good. If you look in years when a Republican was elected, the market was up about 15%. When Democrats were elected, up about 8.5%. So all election years have given us about 11.6% returns. And if you look historically, the markets have returned somewhere in 9 to 10%. So despite this volatility, if we can stay invested, stay focused on what Apollo was talking about, which is just the fundamentals, are companies making more money or not? Investors tend to do really well. And if you look at the economic fundamentals, I'd love to get Apollo's thoughts on this as well, but to me, they look very strong. Interest rates are starting to come down. The Fed made their first cut last week. Corporate profitability is at a multi-year high, with most companies done reporting now for second quarter. We'll start third quarter earnings season here in about a few weeks. But the fundamentals, unemployment's very low, really look good overall, and we continue to be very positive from an overall market perspective.
I love how you bring that up, and I think this is so important because a lot of our clients, again, talk about being concerned about all the volatility that's going on. But what we're seeing very clearly is that historically, election years are the years you want to be invested. Like if you're going to be able to put money in the market, which I'm going to be doing, I just put a little bit more money in both of my kids' 529 plans. And I'll tell you, I invested it in stocks. And again, this is not a recommendation. You want to make sure that you do what's right for you. But for our situation, that's the right thing to do for our kids. And so of any years you really want to be invested, it's this. We had a great question that I wanted to address, and I know that we've actually prepped a slide for this. And great question from one of our listeners. Does the market really care who's president? Isn't it more about who controls Congress? Is that something that we need to be thinking about? And I'll throw that over to you, Matt, because I know that you have a slide on this as well. So,
Sure. I think really to the question, and it is a great question. The market likes a divided Congress. And if we look historically at what's happened there from a return perspective, if we've got divided government, it keeps anybody from being too crazy with the policies. And so that's what the markets tend to like and see the most. With that said, if you look at the market, just this chart that Stacy just pulled up goes back to 1949. You can see there how that has had an impact. And so if we look at, you've got Democratic president on the left in the blue, Republican president on the right in the red. And then if you have Democrat, you see what you get there is about a 13% return. Is that 13.9 if I'm reading that correctly on my screen? And if you have that divided government where you've got Republicans in control of Congress while the Democrats in control of president, you see that's when we get the very best. We've got that 18.5% return there. Same thing on the Republican side. If you've got a Republican president, Democratic Congress, you're seeing that 17.6% number there on the right. And so at least in my mind, and I'd again love to get Apollo's thoughts on this, what that tells me is the market likes the fact that having that division keeps any of the extreme policies from coming through. And so there's that checks and balances that are so important. And we've seen over the last couple presidential election cycles just how important those checks and balances are to making sure our democracy works like it should. That's reflected in the markets as well.
Yeah, and I'd love to hear from you, Paulo. I mean, are you seeing that too? I mean, I feel like the market, does like to have controls, right?
Oh, absolutely, absolutely. And I think that's so interesting because you look at policies that might come, and at this point, as you said, Matt, this is such a close election that nobody can say who's going to win. I don't think that the candidates themselves know, so we don't even know. So at this point, to kind of try to make a prediction about the policies, it's almost like a 50-50. So there's certainly a lot more uncertainty. But the question is, regardless of who wins, what are the impact of these policies, and what's the market thinking about this? And what we see in both the economic intuition, but also the data, is that quite often these policies might not matter as much as people think. And just to kind of start with an intuitive example, and I'll look at some data. If you think of Apple, what might matter more for Apple? The products they come up with, the services, the strategy, how they execute, what competitors do, or who's in the White House. In other words, and Congress for that matter. In other words, a lot of these tax policies that we think that the companies are being impacted by, there are two things to consider. One is that the market prices that in one time right away, and then we're done with that. But number two, companies are really good at taking care of this. They're not going to just lay down and take whatever comes at them. Before I joined Dimensional, like 20 plus years ago, one of the job offers I had was in this area of transfer pricing. And a large company, for example, can take their logo, say, and license it to a subsidiary in a low tax country. And then it pays its subsidiaries to license the logo back. And in the process, it transfers income from the US to the lower tax country. In other words, companies have done this forever. And a lot of these policies might actually, might not be as impactful because the companies have armies of these consultants to help them. Now, what about the data and in terms of the policies and how much they matter? My contention is that the government policies and individual presidential, and I'll come back to Congress as well, might not make as much of a difference because there are other events happening in the world that might drive market returns much more so than the policies of any one president. So I'll go in my lifetime. Stacy, I'm about to turn 55, born in 1969, and what I wanted to do is look in my lifetime at what was the average growth of the U.S. stock market, and that is about 10% per year in the S&P 500, meaning that if you start with $100.69 and the first year you make 10%, by the end of the first year, you'd have 100 plus 10% of that, now the $10, so you have $110, and then you grow it again at 10%, so now you start with 110, 10% of it is 11, so now you have 110 plus 11, you have 121, and you keep growing your money at 10%, and you get a sense of how the market is done. And I want to compare that yardstick of 10% with what happens during different presidential terms on average per year while they were in the White House. So when I was born, President Nixon was in the White House. And for the 5.5 years that he was president, the markets did not grow. In fact, they shrunk by about 2.9% per year. And then his vice president comes along after he resigns for 3.5 years, and the markets skyrocket at 20+%. And then in 77, President Jimmy Carter comes along, a little bit above average, 11.7 during the 4 years that he was in the White House, followed by President Reagan, 15.8% per year for 8 years in the S&P, followed by his vice president, George H.W. Bush, 13.9, so a bit average, above average for 4 years. And then we had President Clinton. 8 years in the 90s, the market goes up 17.6% per year for 8 years. And then we had the Bush versus Gore election. And then we had President Bush for 8 years. And on average, the market dropped by 4.4% per year. And then we had President Obama and then lastly, President Trump. And the reason I want to start here is because if you look at these numbers, let's start with just a very basic question. Is there an obvious pattern that would tell you that having a Republican or a Democrat is better or worse for the markets? And Stacy and Matt, I've asked this question to audiences all over the country and the world. Nobody can tell me there is an obvious pattern. There's no way.
Second, and if you see that, please, put in the question to answer what pattern you might see. I don't personally see that either. And if anything, Apollo, what this chart does, it just gives, I think, a lot of comfort, right? It's really the message that we're sending is that it's really not necessarily about the policy. It's really not necessarily about who ends up being elected. It really just comes down to how our business is performing, right? How our profits, how our
absolutely. Profit. And absolutely. And let's say, so if somebody does want to talk about policies, well, let's take a president who cut taxes specifically to investments, capital gains, and dividends. So in other words, very business friendly and with specific tax cuts that are supposed to help stock market investors. Well, it turns out that that particular president happened to be George W. Bush. But if you look at the numbers, they say he was terrible for the market, and yet he had incredibly market-friendly policies. So should he get blamed for the market doing so poorly? And I don't think it's fair because he walked in just as the dot-com was going bust. How much did he have to do with that? Nothing at all. It's a completely different variable. 9/11 happened 9 months into his term, and he walked off at the bottom of the financial crisis. So should we say that he was not a good president for the markets, despite the fact that he actually had very market-friendly policies? And on the other hand, you have President Clinton. And frankly, you look at the 90s, and I'm not sure that the White House has much to do with Amazon and Pets.com and all the other stocks that powered the dot-com boom in the 90s. But there were enough people, particularly in certain areas, where they look and say, listen, you have a president hyper-focused on business and taxes. And you look at President Reagan, for 8 years, the market did really, really well. 15.8% average annualized during the 8 years of the Reagan administration. And I also remember, Stacy, that not long ago, it was like, not this cycle, a few cycles ago, I would travel across the country. And there was a lot of anxiety that what if we elect a socialist, somebody who would be more focused on social programs than it would be on business and taxes. And of course, that person is President Obama, and a lot of folks were really concerned that the market's going to tank. It's going to be a bloodbath because we don't have somebody who's hyper focused on business and taxes. And some of them were saying, I'm going to sell and move to Canada because this is going to be a terrible situation. And the question is, how did the markets do during a president who is focused on healthcare for the country rather than business and tax cuts? And the answer is during the 8 years, so same 8 years as President Reagan, the S&P 500 under President Obama went up by 16%. How different is that?
Yeah.
I mean, look at the numbers, and I find that over and over and over again, what I'm seeing is that people express their emotions. And what it comes back to me is that a series that I used to watch in the 90s, I don't know if you remember the X-Files, Agent Fox and Mulder. It's my college days little treat on Sundays. But I remember the tagline, which is, I want to believe. And I think that's kind of what's here is a lot of people say, I want to believe that the market does better or worse, but that's not what's in the data. Certainly not. Now,
well, we have a lot more to go through. I want to ask a quick question that was put in the chat, and I think it's a great time to ask it. We've been talking a lot about how policy and focus actually has not had as much of an impact. That's what you were just talking about, Apollo. But a question came in from one of our listeners today. What is your take on both Trump and Harris's economic policies, and whether or not they're going to have an impact on the market? So I'll throw that out to anyone who wants to, throwing the ball up, anyone who wants to take it. Is that going to have an impact on each of their policies, and if so, what should we be thinking about?
Matt, you want to go first?
Sure, I'm happy to jump in. I mean, I think Apollo's point that he just brought up is really the relevant point there. Is you have to think about the president, and Stacy, we just talked on that previous slide you showed about kind of that divided Congress being an important component as well. What it looks like, again, we're guessing because the elections are so close, not only at the presidential level, but also at the House and Senate as well. But the expectation, I think, is we're certainly going to see that divided Congress. And what does that mean? Or divided government. And what does that mean? It means we're likely not going to get a lot of the policies passed through. So, I would tie right back to what Apollo said, which is we can have very pro-business policies, good returns in that environment, pro what we call more social policies. We have good returns in that environment. So there's that balance there. But if you look at the differences between, obviously under a Trump presidency, we'd expect, what he said, lower tax rates, but higher tariffs. So if you look at most economic forecasts, we're going to see higher inflation in that type of environment. On the Harris side, we're probably going to see some higher tax rates, and what impact does that have on companies and how they're structuring their tax savings? Because as Apollo said, they're not going to voluntarily pay extra taxes. They're going to do everything they can to take advantage of whatever there is in the system to allow them to work around that. So I really think, and Apollo, maybe you can jump in here, but I think regardless of who we see there, the checks and balances in place, that divided Congress is going to be important, where the economic fundamentals, we have some of the best companies in the world right here in the US driving that innovation, that growth that's going to drive the earnings to drive the markets as we go forward.
Yeah, and I think you're right. Go ahead, Stacy.
Yeah, no, I mean, I think this is such an important topic, but there are so many other factors that impact the market. I mean, we can talk about the interest rate cuts and expected interest rate cuts, essentially supercharging the engine of the economy, right? Lower interest rates means we're probably going to see the housing market take off. We're going to probably see more business debt and growth and development and putting money to work in businesses. A lot of trickle down things, but a dear friend of mine said something to me that has always stuck with me. And she said, the 100 things that you worry about most likely none of them will happen, and something will happen that you don't even expect nor have on your radar. And so why are you worrying about those 100 things that we know are not going to potentially happen? And you can't even worry about the one that you don't know because we can't even fathom it. And I feel like that's the market too. Like if we think about 9/11, right? Whoever expected that? I mean, I live down here. I'm 2 blocks from the world, where World Trade Center was, but you sometimes can't even fathom. And so when we think about being a smart investor, worrying about all these potential eventualities of how quickly the Fed drops rates or doesn't, of what ends up happening, whether it's Harris or Trump, all these different myriad of factors, ultimately, I think the biggest message is, stay invested,
Yeah.
work with the right team to give you advice on how to make sure your money is diversified to weather through all these things that we may be able to foresee, and quite frankly, the many things that we may not be able to see. So I'd love to just talk a little bit about why staying invested is so darn important. And Matt, do you want to just jump in on that?
Sure. I mean, I think you know me well enough, Stacy, that this is one of my absolute favorite topics to talk about. And if you jump to the slide there that Fidelity put together, which I shamelessly stole from them because I thought they did a great job putting that together. What it shows is, if we stay invested, and so this goes back to 1970, we started with $10,000, and we just closed our eyes and stay invested for this entire time period. That 10,000 grew to be $1 million. If we thought we were concerned about markets and we should get out for a while, Apollo referenced fleeing to Canada, selling all of our stocks and fleeing to Canada, whatever that might have been. And you think about that and just missing, let's say 30 days there, just moving over to that fourth bar on the right over this entire period. So again, this is back to 1970. So that's a 50 plus year window. If we missed the wrong 30 days because we were in Canada, we hurt ourselves. We cost ourselves over $900,000 by getting out of the market there. And I love your point on all these things we worry about. And that's my job. I'm hopefully taking that burden from a lot of our clients by staying up worrying about what can impact the markets. How do we need to be positioned for that? But ultimately letting this engine work for us of this compounded return that Apollo was just talking about. 10% compounded annually over time adds up to a lot of money. And you see that here, 10,000 growing to $1 million. And so ignoring that noise, staying invested, ignoring what is going to be impossible to ignore for what do we have? Apollo, you have the numbers at 46 days left to until the election.
Yeah. Yep. Yeah, it's 46. That's right.
46 days. If we can ignore this for 46 more days, again, not talking about a personal or social level, because I know there are a lot of major issues out there from that perspective, but from that investment perspective with your money, I feel very confident over the next 5 to 10 years that you're going to be very happy that you made that choice.
Yep.
And
go ahead, Stacy.
another great question, and either of you can jump with a really interesting question about crypto. And this person said that they're especially interested in crypto and Bitcoin, which Kamala proposes potentially having tariffs, and concerned that this potentially would shut down in the US and be awful for the market. Right, that's the question. So if there are tariffs to be imposed on crypto, on Bitcoin, would that affect the S&P 500? Like what impact might that have?
Well, first of all, it is impossible to put a tariff on crypto because crypto is basically it's a token and it's a digital token. So a tariff is on a physical product that you import into the country or a service that's being imported, but that's not the thing with crypto. So I think that maybe the word tariffs could be on taxes, but the taxes are currently on crypto. So I'm not sure what the storyline is with that particular tariffs, because there's no You impose tariffs on a box, on a pair of shoes. You can't really impose on tariffs on a digital token. That's just not a physical object. So maybe we need more clarification on that question.
Apollo, maybe on the question that I think might be trying to get at here is this idea of taxing unrealized capital gains. That maybe trying to read into the question a little bit there?
Yeah. So if that's the question, so basically one of the proposals that I'm not even sure it's ever going to go anywhere, because even candidate Harris, vice president, basically kind of like didn't suggest that this is actually feasible. I don't know that that's even feasible to implement, because let's say that you are and these are pretty accurate numbers. You are Mark Zuckerberg, and you own Facebook, and in 2021, well, the value of your holdings is $10 billion. I'm just to toss out a number. So you would be taxed on 10 billion. Well, that year in 2022, Facebook dropped by 66% or 60% or so. So instead of 10 billion, you only have 4 billion. Well, how are we going to pay? What are you going to pay on? Because you don't own as much as you used to, and because these valuations change all the time, I just don't know that logistically it's ever possible to implement something like this. And again, that's a bridge that we will cross when we get there. It's very uncertain. And as Matt said, basically there you have different splits that you can have, the White House and Senate and House and all that. Maybe one of the interesting things to kind of back to what he was saying is, how do you think about this? It's really hard, because if one party controls the House and the Senate, but not the presidency, that you start splitting hairs, and I don't have any. But 3 years ago, there was something that was very interesting, Stacy and Matt, that I thought it was remarkable, because at the time, the Democrats won the 2 Senate races in Georgia, and they controlled the White House, the Senate, and the House at the same time. And that's when it kind of got me thinking, well, maybe that's a natural experiment. What if you look at times when one party is in full control of the White House, the Senate, and the House, and you compare how the markets does when one party is in full control with how it does when the other party is in full control, because that would give you perhaps a better sense of how to think about each political party in a unified government. And over the past 90 years that we have data in the S&P 500, 90 plus years, the Republicans had this unified government control for 13 years. And if you take a simple average of those 13 years, and that's what I did 3 years ago, the average is 14.52%. That's the average growth in the market for the 13 years when the Republicans controlled the White House, the Senate, and the House at the same time. The Democrats also had that unified government control. It turns out that it wasn't 13 years. It was a lot longer. It was 34 years. So the question is, what did the markets do during this single party control of the Democrats? And by the way, 3 years ago, somebody told me very clearly, but I don't know what the number is, but I know you're going to try to support one party or another, try to promote one party or another. I'm just looking at the numbers. So we actually wanted to be triple sure that this is the right number. So we had the PhDs from the research group run the number. And it turns out that if you average the 34 years of the Democrats being in full control in DC, the market went up on average by 14.52%.
Okay.
It is identical to the second decimal.
That's crazy.
So when people are saying that one party is better than another, one set of policies better, that's not in the data. Anywhere you look at it, it's just much more the emotions. And Stacy, you talked about my daughter. That's kind of helped me think a little bit about how to organize it in my head. Politics and elections is one of the many variables that impacts the market. It's just not a primary one, not that you can clearly observe that something happens in the election, the market does that. And the reason I bring in my daughter is because her and I, occasionally we bake cookies. And when you put in the eggs, the sugar, the flour, the butter, you mix it all in and you put in the oven, the cookie's baked, you break it apart. There's no chance you can go and say, aha, I recognize the egg yolk in there. No, you can. It's mixed in with so many other ingredients, it becomes indistinguishable. To me, that's what politics is, the egg yolk in the cookie. It's something that it's in there somewhere. It's not really distinguishable. And the good news, it's not the garlic in a cookie. It doesn't stink it up enough to recognize it. And because of that, we go back to what Stacy and Matt were saying. We do believe very strongly that you are better off staying invested based on the financial plan that Francis Financial did for you, rather than react on the elections and politics, because those tend to be emotional decisions, not really factors that drive the market.
Well, I cannot thank you enough, Apollo and Matt. This was so insightful. And I don't know about all of you attending today, but I feel like hopefully your stress level just kind of brought down between these slides of really showing that, number one, the impact of if it's a Democrat or Republican, really not much difference. In fact, we can look over that time period, exact same on average return. And that also the market likes to see, split houses as well. And then finally, how important it is to stay invested. Some of the best returns are years where there is an election. And, just overall, following the plan, following your financial plan. And I would say that if you are sensing significant concern, significant anxiety, then reach out to us. Maybe we need to talk about what your long-term investment policy statement says for you. It could be that maybe you can take a step back in the risk you take in your portfolio, and your financial plan still works beautifully for that. So again, it's one of those things that we're here to talk to you about, that to make sure that your money is working for you in the right way. But I just want to say a great big thank you for all of you listening. This is being recorded. We'll get this out to you all. And in addition, you can send it on to anyone who has missed in our website, www.francisfinancial.com. If you are not a client and have questions about your portfolio, please do reach out to us. We can work with you along with Matt, our Chief Investment Officer, to do a full analysis to see how you're invested, where there might be some opportunities, and where there might be some tweaks that make sense for you and your portfolio. So a great big thank you again to all of you listening, all of you who are participating, and a great big thank you to our wonderful, wonderful guests, Apollo from Dimensional Fund Advisors, and also Matt, who is our Chief Investment Officer here at Francis Financial. Thank you.